The headlines are everywhere and they're alarming. Global banking crisis, one problem down, too many others left to go. Fed leads global liquidity boost as bank crisis deepens. Credit Suisse's death gives birth to new type of bank crisis. Global banking crisis, what just happened? That's a good question today on Expert Connections. There are a lot of lessons to be learned, and I'm sure many more still to come in this global banking crisis. Welcome to Expert Connections. I'm Julie Holton. Today, our focus is on what local businesses need to know. I'm joined by Eric Waggoner, managing partner of Waggoner Financial and an assistant professor who teaches financial risk management at Michigan State University. Eric, thanks for being here.
Thanks for having me.
Eric, you are describing the situation saying that it's not a crisis. So let's describe, for those who think it is or those who aren't sure what's happening in the banking world, let's describe for them what's happening.
Yeah, so first off, no one knows what the future holds. I don't have a crystal ball. I don't know what's going to happen in the future. But me personally, I wouldn't characterize what's occurring right now as a crisis. Certainly, it's a crisis for some people. If your bank just got shut down, or if you just got laid off at Meta, for instance, you would probably characterize this as not the best of times. But there is definitely a big difference between what occurred in 2008, which we call the 2008 financial crisis, and what's happening right now. It's very different.
So what is happening? I mean, let's kind of back up to this time last week. Let's say last Friday. And at that point, the shutdown of SVB, of Silicon Valley Bank. Walk us through what happened in that scenario? What caused this shutdown?
Yeah, so in general, several things happened with SVB. The first one of them was that they lost a lot of deposits in a very short period of time. So that's never good for a bank, because a bank, the way you want to think of a bank is they don't really have money, right? They borrow your money and then they lend out your money, right? And so what the bank does is they borrow money short term and they call that deposits, and then they lend it long term. They call those mortgages, right? And then that when you leave money at a bank, they pay you this much, but when you take out a mortgage, they charge you this much, right? And so that's how the bank makes money, and that's called the net interest margin. But the problem for the banks, though, is that they're borrowing short term and lending long term. So the way that banks make money is they make money on the spread, but they have to manage that risk very carefully and very efficiently. So if they lose a lot of their short term lending, now remember, when you leave a deposit at a bank, you left your money there. So you're loaning to them. People don't think of it that way, but you're loaning to them. And you can call those loans back at any time. You can go grab your money at any time. And so that's what happened to SVB. They lost a lot of deposits in a very short period of time, and that's never good for a bank. Another thing that most banks in general are struggling with is that there's a relationship between bonds and interest rates, and that relationship looks like this. They're opposite. So if interest rates go up, bond prices go down. But if interest rates go down, bond prices go up. So what we're seeing right now is the Fed is raising interest rates really fast. So that means that these banks, even if they invested in very safe things like treasury bills, those treasury bills prices are going down really fast. And so that makes the banks appear to be less financially healthy, even though they own the same, they own, if in the case of US Treasury bills, they own the safest thing on the planet, okay? But sometimes they have to mark those securities to market, and just even if they plan on holding them, if the price goes down, it just makes them look less financially healthy. So they're struggling with how to deal with that.
And certainly if there's a run on the bank, then there's going to be a difference in the liquidity that they have, right? Versus, those who are seeking to find withdraw their money from the bank. Can you talk about one of the main differences between what you see happening now with SVB and, say, for example, back in 2008? You were talking earlier about one of the main differences in kind of the government's hand at play here when it comes to inflation.
Yeah, the big difference is that in 2008, the Fed was reactive. And in 2023, the Fed is proactive. So in 2008, the Federal Reserve was reacting to something that they didn't cause, but it was just kind of a mess they had to clean up. But in 2023, it's very opposite. This was almost inevitable that some banks were going to, be under a lot of stress because the Federal Reserve is doing that on purpose. The whole point of raising interest rates is to put banks under stress. They don't want them to be stressed, but they want them to contract credit. And they usually won't do that unless they're stressed. And so they want them to contract credit. Inflation comes because prices are high, and prices are high because spending is high. And spending comes in two forms. You either have cash or credit. And so the Federal Reserve is trying to make it so that the banks won't give people as much credit so that they won't have as much to spend, and that'll just naturally bring down the prices. But if you've got maybe about a minute or two, I can definitely give you a little bit of a better idea of the difference between 2008 and right now. Can I go ahead and do that?
Yeah, let's do it. Yeah,
all right, so
walk us through it.
Okay, so in 2008, the Federal Reserve's balance sheet was about $800 billion. Okay, 800 billion. That's just what I want you to remember, about $800 billion. And we had a real financial problem. We got really financially sick. Mortgage-backed securities were basically blowing up. I mean, they were just people had taken a lot more risk than they knew they had. The point is that in 2008, we were financially sick. And so the Federal Reserve did something really extraordinary at the time. They printed a lot of money. And that's financial medicine. So we were financially sick and we got financial medicine and we got better. And frankly, the Federal Reserve did a really great job. The problem, though, is that we kept printing money. After 2008, we continued to print it in 2009, 10, 11, 12. Okay. So we kept taking that medicine, even though we weren't sick anymore. All right. And that doesn't have the reason that you don't want to do that is because you get inflation, but you'll remember we weren't getting inflation. So if there's no penalty for printing money, why stop doing it? So that's what they did. Finally, during COVID in 2020, when COVID happened, we got real sick again. And so we printed a lot more money. The difference, though, was that this time we weren't financially sick. We were physically sick. And the Federal Reserve printed a lot of financial medicine, but we didn't need it. So that caused us all to consume a lot more than we produced. And then we really did get the inflation. So the Federal Reserve needed to it was like the hokey pokey. They needed to get that money out of the system fast. And they just didn't get it out fast enough. So we started getting a lot of inflation. And now they have realized that, inflation is bad, right? Because maybe it doesn't hit you that hard. Maybe it does. I don't know. I don't know your particular situation. Maybe it doesn't hit some of your viewers hard. Maybe it does. I don't know. But it definitely hits people that don't have money very hard, because people that don't have money, if eggs are too expensive, they can't buy their kids baby formula. They can't move from one, they can't afford gas to go from one place to another. So inflation is really, really painful, especially for people that are at the lower income spectrum. So the Fed, in order to stop that, has had to start sucking money out of the system. And we've got to feel pain in one way or another. And the Fed basically just decided that it's going to be the banks and not people at the low income end of the spectrum.
That's a great explanation. That visual really helps, Eric. I want to kind of bring this into maybe some of the business basics, if you will, the banking basics for businesses, because I think a lot of us realized, this was an unfortunate wake-up call. And I word it that way for those of us who did not have money at SVB. So obviously a much different scenario for those folks. But for the rest of us watching this unfold, this is a huge reminder about some of the basics. For instance, is my bank FDIC insured? And if so, what is that insurance amount? Can you talk us through some of those basics that you advise people? What are the things that businesses really need to be looking for when they're considering their banking options?
Yeah, so if you remember, and I'm going off of my memory here, so please forgive me if I get something a little wrong, but I mean, the FDIC insurance used to be $100,000 per deposit, and the bank, and the reason that it's $250,000 now is because during 2008, the regulators wanted to extend protections, because they knew that some people had to get hurt, maybe Bear Stearns and Lehman Brothers, but they didn't want everybody to get hurt, right? So they started to extend safety nets. And they've already started doing that here in 2023. For instance, they protected all the depositors at SVB. So at Silicon Valley Bank, all the depositors have been protected. Now, they've been careful to say that they're not infinitely backstopping everybody. In general, you should only count on having $250,000 of FDIC insurance. But I just wanted to point out that the Fed, they want there to be some pain, but they have the ability to stop it. Okay, so I wouldn't want, I don't think that that's why I wouldn't characterize this as a crisis. I don't know if that answered your question, but I wanted to make sure I hit that point.
Yeah, it does. That's a great point. And I'm curious from your aspect, Eric, is there anything else that, any other lessons for businesses specifically to learn from this situation?
I would say two things for businesses. First off, we're going into an environment we're going into an environment where inflation has been particularly sticky and interest rates are high. And, the interest rate cycle is long. So people are probably not used to having ever lived in a time when interest rates were high. Back in the 80s, interest rates got up to 10, 11, 12, 13%. I mean, it's a very, and we had just dealt with a high inflation environment in the early 80s and the late 70s. So businesses should prepare for that money is going to be more expensive. The Federal Reserve is trying to contract credit. It's going to be less easy for you to have access to capital. So I want to say two things to businesses. Number one, that your ideas have to be better if you're going to borrow money from them, right? And that's what makes us all more efficient. You can't just borrow if money isn't free anymore. So you can't, you have to have good ideas, not just some ideas. But the second thing I would say is that there's going to be winners and losers. And so I want to drive this point home. Anytime that there's chaos, there's always opportunity. One of my favorite sayings is the best time to take a piece of pie is when the pie is being passed. So you might be, the business conditions for you may have gotten worse, and you may feel a little crowded in, but you definitely want to be looking for opportunities. I mean, this might be a situation where things are worse for your competitors than they are for you, and you should be looking for ways to take advantage of that.
That really resonates, Eric. I remember, it feels like just yesterday doing some of these interviews at the start of the pandemic. And in particular, John Mashney, an attorney, had said, with a lot of optimism and positivity, this is when innovation happens. And I remember thinking, oh my gosh, I'm so exhausted. We're like a week and a half into the shutdown. And what are you talking about? But you have the same sentiment there, that this is where you look for those opportunities. So what great advice. Eric, anything else before we wrap up here that you want to share with our viewers?
Well, I would just say that, you got to take the good with the bad. And this is why we play the game. And, you're seeing financial evolution. The healthy companies are going to get a lot stronger throughout this. So, always be looking for chaos for opportunity within chaos. So.
I appreciate your insights today, Eric. Eric Waggoner from Waggoner Financial. Thank you for joining us on Expert Connections.
Great to be here.